This is Don Kaufman, and you are watching the TheoTrade evening video for March 10th, 2021. We start inside of the S&Ps, which are literally a stone's throw off all-time high. Can't believe we're actually saying that after some of the wild volatility that we've seen. But before I go any further into detail in this evening's video, you got to understand that there are quite the number of risk metrics that are still just bidding higher and higher. And I'm actually going to display that to you here momentarily. Again, let's actually kind of start this evening taking a look at the S&Ps. More appropriately, this happens to be none other than the spiders. And as I was just delineating a moment ago, well, the all-time high is right here, right around 394. The S&P is closing, as I said, just a stone's throw off of those. In fact, another way to kind of distinguish, if you will, not only the all-time high, but what's expected out of the marketplace. In fact, this is one of the first things that I really want to kind of dig into a little bit deeper this evening. Happens to be none other than the expected move. So if you're a little newer to TheoTrade, we talk about the expected move continuously. All right, what is it? For the most part, the expected move, all right, this entire week, we're looking for like this 100-point move to the upside, okay, or 100-point lower. And it was literally like at 100 points. Where'd the $100 come from? That was the SPX options marketplace that depicted, okay, forward risk for this entire week of trade. So effectively, I look at like a Friday to Friday expected move. That means on a Friday afternoon, I'll look at what the anticipation of movement is going to be based on the options market for the next Friday. So this was showing expected move about $100 higher or lower. So that would actually take us up here inside of the SPX to, well, 39.40. Or down here to basically, well, 37.40. Couldn't have been more round numbers, right? So $100 move. And one of the things that's kind of surprising at this point in time is that we haven't actually tagged the upper end or lower edge of the expected move. Now, for those of you that do tune into a lot of the videos and the evening videos, I talk about this incessantly because there's an incredibly high probability of touching the edges of the expected move. And this actually gets into some of the mathematics of trading a little bit, but there's actually what we call probability of expiring and probability of touching. And if you look at a distribution curve, a moment ago, I just talked about, this plus or minus the $100. So you're supposed to go, up $100 this week, or again, down $100 this week. But that expected move, okay, that expected move is actually what we term a probability of expiring. Basically, you're supposed to be, the probabilities we're supposed to expire inside that range. We're supposed to stay in that range about 68% of the time. Nevertheless, there's also what we call probability of touching. And probability of touching, okay, is much more substantial for trade during the week. And it basically says, it's almost a foregone conclusion that we're actually going to tag the upper end or lower edge of the expected move. Now, where are we right now? Well, this couldn't be easier. The SPX closed basically at what, 3,900. The upper edge is at 39.40. So we're a hop, skip, and a jump away from the upper edge of the expected move. So the easiest thing to say is, listen, the highest probability right now is that we're actually going to tag 39.40, which basically takes us, again, within a stone's throw of the all-time high inside of the SPX. That's the easiest thing to say. But one thing you have to understand about the mathematics of expected move is expected move knows nothing about direction. So there's still going to be, if you will, Mr. Toad's Wild Ride is going to get loose on Thursday or Friday of this week. I would expect some more volatility in the marketplace. Now, the other aspect that really should resonate with you, and I've talked about this also kind of incessantly, specific levels inside of the S&Ps. One of those levels happens to be none other than, okay, 39.11. And you'll hear me talk about this all the time, 39.11, okay, where the S&Ps, and this is now, I'm actually on the S&P futures. The S&P futures have been migrating right into the 39.11 handle consistently. You'll probably see us trade there in the overnight. Breaking off, though, 39.11, and again, I'm going to get really specific on you here for just a moment. If the marketplace, all right, comes off the 39.11 to the downside, and we actually break through 3900, it's a very fast, very clean shot to 3880. And you'll actually see that it occurred, okay, during today's trading session. We basically bounced back off of it to, well, for the most part, right there, that was a 39.11 that was actually tagged. We came off hard and fast all the way down to 3880. We actually bounced, and that's pretty much the high out of the day. Nevertheless, an overnight trade, expect the that 39.11 kind of handle. Now again, that's for the most part to the downside. I've already kind of painted a little bit of an upside picture, which takes you into the into kind of the 39.40 handle. Okay, let's move on for just a moment. So the S&P is recovering. The Nasdaq, it's nowhere to be found. The Nasdaq is still, it's down and down substantially. In fact, if you look at the QQQ and the QQQ in a year-to-date percentage, okay, when I say it's down substantially, I'm talking about the fact that it was up almost 10% on a year-to-date basis, and now it's massively unchanged. Okay, the Russell, well, I'm just showing that the bifurcation still exists, right? We have not had yet, you know, full-blown correlation to the downside in the marketplace, and this bifurcation, it's a scary one. I mean, take a look. The financials, they're just ripping, right? Energy sector, the energy sector is up 40%. This thing is going to probably get decimated sooner or later. But the trade, it continues. And this is something that, again, I am maintaining positions in here, and will continue to maintain positions, because things like this, I mean, this is just a wonderful risk reward on the short side. And that basically means this, you know, if you look at a position like this, I mean, you think to yourself, well, what's the upside potential? I mean, look at the run in here. It's a 40% year to date. What's that upside potential, okay, versus some of the downside risk? And the answer is, I don't think they're equal right now. I think there's much more downside. That's why I'm actually going to maintain a short position inside of the XLE. All right, changing things up a little bit. One of the things that I really want to leave an impression with you this evening has everything to do, well, with risk metrics. Right? Specifically, we could talk all day till I'm blue in the face about volatility. One of the things a lot of people look at is, like, you know, the VIX. So the VIX has actually collapsed quite a bit lately. I mean, listen, you're 4 trading sessions removed from a 30 VIX. We're all the way back to a 22 VIX. But one of the things that you have to keep in mind about the VIX, I started looking at forward VIX pricing. When I say forward VIX pricing, I wanted to see, like, what's the future of the VIX pricing. And if you look, like the at-the-money options here, and again, I'm going to highlight this for you for just a second. The at-the-money option, way out here, you know, about 70 days out, they're already actually pricing the volatility to revert back up and up substantially. I mean, for the most part, right here, the 28 strike, okay, is pretty much what they're pricing the 70-day volatility to be. What I'm actually saying in this particular context, and this gets a little out there for a moment, but hey, listen, people look at the VIX, okay, but the VIX does not price the VIX options. Okay, all right, VIX futures price VIX options. So if you're looking 70 days out, you're like, oh no, the VIX is at 22. No, it's not. Okay, the VIX 70 days out is much closer to like, it's almost at like 28. In fact, if you go look at the volatility futures, cruise over to the volatility futures and look about that 70 days out, all right? So we're going to cruise out there. There's 70 days. Look, it's 27, okay, 27.71. And I just want to highlight that for a second. So one of the first risk metrics that everybody looks at, okay, you should realize that the forward future of the VIX is already pricing reversion to the mean. So if you think, oh, I think volatility is going up, well, guess what? So does everybody else. It's already priced in, right? So there's what they call, you know, contango and backwardation over here. The bottom line is this: the VIX, the volatility curve is an extraordinarily steep one. And the volatility curve looks like that right now. It's crazy, okay? And when I say it looks like that, what does that mean? Like, what does that mean? It means like front volatility is like 23. Back volatility is like almost all the way up to like what? 20, you know, 28 and a half. It's crazy. Like huge differential between front and back volatility. Back month volatility portrays much more risk. But that's actually not what I'm here to show you, okay? So what other risk metrics really are on my radar screen? I've been showing this quite a bit lately, but we're actually going to go to the VVIX. The VVIX saw something today. Don't know what it is, but it's up like 5.5%. This is the volatility of the VIX. So VVIX is actually on the bid. What that effectively means is that, hey, just because the volatility went down though, traders are actually out there, okay, and apparently they're buying calls, and they're buying calls. And there's not like necessarily inordinate volume in here, like the call sizzle. This is today's option volume versus the previous 5 days, and the call sizzle is basically 1.4. So we're trading about 1.4 times the norm. 500,000 calls effectively traded in there. Neither here nor there. You don't look at put call ratios, none of the, none of that. But I just wanted to bring that to your attention because there's volatility being bought in the VIX. Now the other one, so again, you see forward pricing of the VIX that's much higher, but then you actually see volatility being bought up in the VIX. And again, this is fairly substantial because, when you get back up to like the 114, 115 handle inside of the VVIX, this is what we call the VAMA zone. It's the volatility, the VAMA zone. Just things get wild inside of the marketplace. Okay. It is indicative of professional hedging activity going on inside of the VIX. Last but not least, in terms of a risk metric, this one's soaring. It's the SR VIX. Okay. I can't stress this enough. Okay. This is an interest rate swap volatility index. This is an over-the-counter marketplace. All right. This is a very professional level product, and you got to open up like 3 years of this thing. We're soaring. Okay. There's something going on in the credit markets. I've been screaming about this now, okay, for a few weeks. That's something, it's like the situation is coming to a head. And you have to recognize that the bond trade, okay, the bond market, it mellowed out like the last few trading sessions. And because the bond market mellowed out and started to come back up, everybody starts to sound the all clear inside of the S&Ps. I am not here to tell you. I'm going to say this again. I am not here to tell you that the S&Ps are not going to crack to all-time highs. I am here to tell you, though, okay, that it is incredibly odd that this number, again, of risk metrics are on the bid. Okay? The one that concerns me the most is without unequivocation that SR VIX. This is something I'm going to dig a little bit more into, okay, in the morning session here at TheoTrade. I want to thank everybody for joining us. Have a wonderful evening. Bye-bye.